Hello everyone, it's Fung here again. Today we'll be talking about interest rate risk, and again the information here is sourced from the book The Truth About Money by Rick Edelman. So getting started, we learned about all different types of risks, and we previously covered default, liquidity, inflation, and tax risk. Now we're learning about interest rate risk, which is the risk that interest rates will change and have adverse effects on your investment. It's one of the worst risks to have, and this is because it's a major cause of investor losses. So the reason why interest rate risk exists is because interest rates impact a bond's value. They actually have an inverse relationship together, meaning that as interest rates go up, a bond's value goes down, and as interest rates go down, a bond's value goes up. What also impacts a bond's value is its duration, which is just the projected life of a bond. It's not to be confused with maturity because maturity is when you get your principal back at that set date, and actually the duration can be shorter than the maturity. And the reason why duration impacts a bond's value is because the longer the duration, the more extreme or volatile the value swings are to interest rate changes. So for example, a 30-year bond's value is going to lower way more than a 1-year bond when it reacts to a +1 in interest rates. This is because the 30-year has way more income, cash flows, generation, because that's 30 years worth of it. So it's going to react way more than that 1 year of interest rate change. So after hearing about interest rate risk, you're probably wondering, how do I beat it, right? How do I win against interest rate risk? Well, the trick is to simply hold on to your bond. The only reason why you would lose money in times of rising interest rates is because you're selling the bond because it's losing value, and you're scared of that, or you want to chase higher interest rates. But the truth is, your issuer is already paying you the face value of your bond at maturity, so you really shouldn't sell your bond because then you're losing money. You won't lose any money if you just hold on to it, okay? So talking about selling bonds, the reason why you can even sell them in the first place is because they are negotiable securities, which are when prices are negotiable between buyers and sellers. Remember the inverse relationship, so as interest rates fall, bonds will profit, and as interest rates rise, bonds will lose money. You have to remember that a bond's income is fixed, but its value fluctuates wildly based on interest rates. So because of this, changing value, you can actually trade bonds based on interest rate speculation, right? If you think the interest rates will fall, then you're going to buy all those bonds and then profit eventually when they do fall, right? So people actually trade these similarly to stocks, where stocks move by pennies, which is just 0.01 of a dollar, where bonds move by basis points, which is 0.01% of an interest rate change. So after hearing about interest rate risk, you're probably wondering, should I even buy bonds? And the answer is it's going to depend, okay? It's going to depend on interest rates in the future, because if you buy a bond and rates go up, your bond's going to lose value. If you buy a bond and the rates go down, your bond's going to grow in value, which is good. And if you buy a bond and rates stay the same, then your bond stays the same, which should be good because you already agreed on that face value at maturity, right? So that means 1 out of 3 possibilities you're going to lose. And you can actually mitigate this losing scenario by just limiting your interest rate risk and credit risk. And you do this by buying short-term bonds because you have to wait till maturity, remember that, and that you could just buy higher quality bonds. So some people believe that gold protects you against rising interest rates. In fact, that isn't true, okay? That's not quite true. And this is because gold is a speculative investment where returns are not guaranteed. It has no conclusive relationship between interest rates and dollar values. And yes, gold is a viable investment and it's good to diversify your portfolio in investing in gold, but it's not a good hedge against other investments because there's no guarantee of protection. So recapping everything that we learned. First is that interest rate risk is the risk that changes to interest rates will negatively affect your bond, and that their interest rates move inversely with a bond's value, right? If interest rates go up, a bond's value goes down, and vice versa. That interest rate risk is beaten by holding onto the bond till maturity because you already agreed on that, value at, that face value at maturity. You only lose money if you sell it. Bonds are a negotiable security that can be bought or sold prior to maturity. That's why there's a whole exchange in a market for those. And that bonds, like losing value, that can be mitigated just by buying short-term bonds. And lastly, gold does not protect you against rising interest rates. Remember, it is a speculative investment. So that's it for the video. Thank you guys for watching. Like, subscribe, do what you will. Not obligated to do so, but I'll see you guys in the next one. Peace.